Well, hello everyone, and good afternoon to all of you. Hope you and your families are still doing well, and really thank you for spending this afternoon with us here at one of our webinars, which, as I always say, they've proven to be one of the best discoveries that we've had over the pandemic and over all these difficult times. The level of attendance keeps really high, and the level of satisfaction as you give us your feedback is also very high. So I'm very happy for that. And today we are going to have a discussion on one, I would say, which is one of the two top topics for ASCRI, has been like that for the last few years, which is to find the rationale why large institutional investors like insurance companies and pension funds, the local ones, do not invest in our asset class as much as their peers do in other more sophisticated markets and in other geographies, namely Canada, the US, UK, or Germany. And for that purpose, we engaged with BCG at the beginning of this year, and we produced the presentation that you are going to see today. Maybe some of you have already seen it in some format or in some articles. And the work that BCG has done, and I really do want to thank you, Ignacio and the team, for the quality of the paper that you've produced, goes deep into the roots of this issue and gives us some clues on what do we have to do as an industry, both in terms of training, culture, but also in terms of working with regulators, and both at the UE, at Spanish level. And with those clues, we're doing an action plan, which we've started to implement, talking with the relevant people at the different government bodies. So today, what we're going to do is we're going to have a short presentation. So thank you, Patricia and Ignacio, on the material that was produced, and then we're going to have a debate, which is going to be where the master of ceremonies is going to be my dear friend Miguel. So thank you very much for getting all of us together here. And also, I really do want to thank you, Axel and Nicolas, for spending some time with us, because I'm sure that your perspectives, your ideas, and your experience, which is vast in this area, will help us put some light on what we should be doing to close the gap with other economies. And without further delay, I leave the floor to you, Ignacio. Thank you very much, and hope you enjoyed. Bye.
Hello, good afternoon. Thank you, Aquilino, for the opportunity to work with ASCRI on this study, and thank you to all of the participants for your relevant contributions and support. As a matter of introduction, I'm going to briefly share with you some of the key findings of the study, and after that, my colleague Patricia Durant will comment on them in more detail. The private equity sector in Spain is having a better relative performance than the sector in Europe. However, Spain still has room to grow to catch the best performers. For instance, institutional investors in Spain invest less in private equity than their international peers, and invest mostly outside Spain. And this is particularly acute with insurers and pension funds. This is the reason we have focused our study on them, and we found that there are no specific reasons in the asset class itself, as it has a very attractive performance. And also there are no specific reasons in the Spanish private equity market, as it is competitive with good returns, good investment platforms, good reputation with LPs, etc. At last, there are increasingly more and more examples of pension funds and insurers investing successfully in private equity. So the reasons for the lower level of investment by insurers and pension funds in Spain are mostly related with the specific factors that don't favor investing in this asset class. For instance, the high profitability of fixed income in Spain until recent years reduced the need to turn to alternative investments. And also, the pension funds and insurance regulations don't favor the investment in private equity. We believe that improving this situation is feasible, given the success of private equity among international players and the good shape of the sector in Spain. And with this objective, we have included a set of recommendations directed to the main players. So now I'm glad to introduce Patricia Duran, BCG consultant that did a great job in this study, and she will share with you its main contents and recommendations. Thank you very much. This is all from my side. Patricia, all yours. Bye-bye.
Thank you very much, Nacho, and thank you very much, Aquilino and ASCRI, for inviting us to this event. So now we would like to share with you some of the key findings of the analysis that we did at the beginning of the year. We would like to divide it in 5 topics that Nacho has just mentioned. So first of all, we would like to highlight, I give you a snapshot of BCMP investments in Spain. Then we will go and deep dive a little bit on the attractiveness of this asset class, to see it in some success stories of some international and national investors, in some of the specific characteristics of Spain, and why, to understand better why insurance companies and pension funds hadn't invested as much on this asset. So therefore, going on the first topic, we would like to tell you a little bit about the development of BCMP investments in Spain. In 2019, it was the first year that BCMP investments in Spain were above the European average. Nowadays, BCMP investment in Spain are increasing. Yes, we still have room for improvement compared with leading countries such as the Baltic states or the United Kingdom. One of the reasons that we have seen why this investment hasn't increased is, as Nacho and Aquilino just mentioned, that pension funds and insurance companies are not investing a lot in this asset class. If we compare this with other geographies, such as the US, we can see that pension funds that in the US invest around 10% of their available funds in PMBC. In Spain, they do only invest around 1%. Moreover, this small invested amount is mainly invested in international GPs. And this is something that we have seen in different investors. As I was mentioned, insurers and pension funds in Spain only invest 25% in domestic assets, and mainly the rest is in international assets. As a result of all these factors, we are seeing that BCMP investments in Spain heavily rely on investment by international GPs. Investments by international GPs account for around 80% of the total investment in Spain. And this is something great and something that we think that we should maintain and further encourage. But at the same time, we also believe that insurers and pension funds should foster this type of investments and diversify their BCMP investments. Why do we believe so? We believe so because these type of assets are very attractive, because of several reasons that we would like to share with you now. First of all, BCMP has steadily yielded attractive returns in any region and investment strategy. What we have seen is that this asset class has provided high returns, around 12 and even 18% in venture capital in different regions, in Europe, in North America, and in Asia, for example. And this compared to the around 8 or 10% that is returns that are provided stock exchange. This shows that this asset class is very attractive and can provide higher returns than other assets. Furthermore, BCMP offers very attractive differential risk profile because they are quite non-related with the economic cycles. What we have seen is that this asset class has provided attractive returns on a sustained basis along different years with expansive and recessive cycles. Therefore, this asset is very attractive because it will give stability versus changes in the economic cycles. Moreover, BCMP investments also support high risk diversification, and they can provide even value at risk around 0%. Just investing in some portfolios and with a reduced asset class, we can see that the value at risk can be around 15 or 23%, which is much lower than the standard risk applied by Solvency II. Therefore, the value at risk of this asset will never be a problem. But if companies manage to have a large enough portfolio, this value at risk can be reduced even to 0, providing a very attractive condition. And all these characteristics that we have just seen is something not unique of other geographies. We are seeing this in Spain. What we saw in our analysis is that the attractive returns that we are seeing in other geographies, such as Europe, UK, France, or Italy, that we mentioned before, and that we saw again, that they were around 15%. They are also in Spain. We have seen in the average return obtained by Fondico and by other portfolios and other investors, that the profitability in Spain is also around 11 or 18%. And in our discussions and interviews with several investors, they all highlighted this competitiveness of the Spanish asset. And we are seeing this in the market. For example, in BC, this type of asset is demonstrating its ability to generate significant returns and a growing number of deals. In the last year, we have already seen some deals above 1 billion, and we are seeing an increasing level of transactions in the last year, as you can see in the graph. And all these characteristics, these attractive factors, have been seen by many investors, and we would like to show you some of them. In the international perspective, we have analyzed some cases such as the Canadian pension plan, the Swedish public pension funds, some endowments, or some public retirement plans. And in all of them, we've seen some characteristics. They are all getting double-digit returns on their investment in this asset class, around 12, 15%, even 20. And they are all engaged and they want to increase their investment in this type of assets. We are seeing that this asset class already accounts for 8, 15, and even 37% of their portfolio, but they want to increase this investment and even go more complex on type of investment, moving towards direct or co-investments directly with the private equity funds. And as a result of this, we would like to highlight one example of the Canadian pension funds. We've seen in the major Canadian pension funds that they have a lot of investment in PE and VC, that 85% of their growth has come from the return of the investment. Thanks to the investment in these assets, they have been able now to manage 56% of their asset base. So it's very attractive and it can provide a lot of growth to the investors. And in Spain, we are also seeing this. We have talked to many investors such as Fondico, Loreto Mutua, or BBVA, and all of them also said that BCMP in Spain has allowed them to have double-digit returns, and they want to increase their presence of their asset class because they do really believe that it's a valid and attractive investment. Therefore, when we saw all these factors, we ask ourselves, why then are not insurance companies and pension funds investing in BCMP in Spain? And as Nacho mentioned, it's not an intrinsic characteristic of the asset, it's because of the characteristics that Spain was facing. One of those things is that up to now, the return on fixed income securities in Spain had been high, so there was no need to turn to alternative assets. These companies were able to have quite attractive returns with low risk investing in treasury bonds. As we can see on the graph, in Spain, with the green line, treasury bonds have been giving higher yields than in other geographies. Therefore, insurance companies, for example, were investing around 53% of the portfolio in this type of assets. Moreover, the regulation has encouraged these assets. We have seen this with 3 regulations, such as cascading fees, the maximum investment ratios, and the reimbursement windows, because they have either limit the amount that employment funds could invest in the case of the maximum investment ratios. But they have also discouraged this type of investments. For example, their investment window regulation encourage to invest in more liquid assets, and the cascading fees encouraged to invest in other assets that had lower managing fees despite they had lower returns. Moreover, for insurances, Solvency II regulation has also established high levels of capital consumption to BCMP. What we've seen is that BCMPs have the highest capital burden, that is at 49%. This contrasts with the more favorable regulation that Solvency II has given to other assets, such as infrastructure funds, that now they had a 30% capital burden compared to the 49% that they had before. We do believe that the characteristic of the asset class could justify to lower the burden capital. And in the future, we think that this situation is going to change, and probably the characteristic of the country will change and further boost this type of asset class. Mainly, we would like to highlight 3 factors in the future. First of all, as mentioned before, the interest and the returns provided by other assets will decrease. Therefore, the companies will have to look for alternative assets with higher returns. Also, we are already seeing this growing interest from insurance companies. We are seeing that some companies such as Mutua Madrileña, Mafre, or Santa Lucía are entering the market or increasing their presence in BCMP investments. And finally, we think that some of the new regulations that will come, the one around pension funds and probably some changes in Solvency II, will take away some of these disencouragement rules and will increase the investment in this asset class. Therefore, finally, as a result of our analysis and of this report, we came up with some recommendations for all the players in the sector. For BC and PE sector, we do recommend to increase the visibility of the assets and their attractive returns in terms of profitability, but also in social impact and sustainability, to keep on and strengthen the focus on advising these type of companies. For insurers and pension funds, we believe that they should keep on working with the regulator to improve the situation that they do have now and the limitations, and keep on investing on this type of assets. And finally, to the regulator, we do believe that they should change some of the rules mentioned before, such as the cascading fees, the investment ratios, and Solvency II, and also increase their presence with the public pension fund. Now, I would like to give the word to Miguel, Axel, and Nicolas that will explain a little bit more about their experience in the panel.
Thank you very much, Patricia. My name is Miguel Zurita. I'm a managing partner at Altamar. I thank you everyone for participating in this webinar today, and particularly to Axel Hoffman and Nicolas Garzai. I think I'm delighted to have them with us, which will be able to provide what this panel is supposed to, is to give us an international perspective, speaking from their experiences. We've been seeing the research from BCG showing the benefits of private assets and VC and private equity in particular. Hopefully, with the conversation with our panelists today, we'll be able to gather some empirical evidence as well. Let me first introduce both of them. Nicholas Garside, he's a UK national. He graduated from Durham University and obtained a master's degree from Cambridge University. He started his career as a fund manager in Mercury Asset Management. He moved then to Schroeder Investment Management, where he reached the position of head of global fixed income. And from them, he moved to JP Morgan Asset Management as International Chief Investment Officer for global fixed income, currencies, and commodities. Currently, Nicholas Garside is since 2019 a member of the Board of Management and Chief Investment Officer of Munich Reinsurance Company, and he's responsible for group investments and third-party asset management. Thank you, Nicholas, for joining. We also we have today with us Axel Hoffman. Axel, actually, he is trained as a mathematician and has a degree in mathematics and insurance sciences from the University of Munich. He also has an MBA from the College of Insurance in New York, and he's a chartered financial analyst as well. He started his career in Munich Re in the actuarial department, moved through the ladder in different positions until he moved to AXA, first in Cologne and then in Belgium, where he had the position of Chief Investment Officer and member of the board. Axel is since December 2013 a member of the board and Chief Investment Officer of Volkswagen Bund. So Axel, again, thank you very much for joining us. So I would like first to ask our panelists to give us an introduction about their business, their AUMs, to give us an idea also, and in particular about the private markets program, a little bit about size, age of the program, and the objectives. So focusing a bit on qualitative and quantitative information, and if possible, with a particular reference to private equity. If you want, we can start with Axel. Please, Axel, could you give us a view of what Volkswagen Bund is and the size of your assets and your private equity program, please?
Mm-hmm. Yes, sure. Thanks, Miguel, for the kind introduction. So also warm welcome from my side to the audience. Happy to share some insights with you today. So yeah, our name is a little bit old-fashioned, Volkswagen Bund insurance companies. Indeed, we have more than 100-year history. We are operating in the German market, in the life and in the P&C business. The main focus and also the source of the assets is from the life side. And basically why we are special is we are focusing on the independent financial advisors. And that's why also some of our customers, they don't know our company and brand name, they more know the name of the advisor that basically did the brokerage and then sold our life insurance or annuity product. So basically, that's why we are proud to be innovative, because if you're not operating with tied agents where you can tell them that's what you have to sell, but you're in the market of the independent financial advisors, you have to be innovative so that they like working together with you and recommending your products. When I joined the company, we had a rather challenging issues on the asset side. Because yeah, that was directly before Solvency II, and we had some issues on duration and convexity side, because on the life side we grew very strong with annuity business, and that means we have rather high durations. So when I joined, I didn't believe that the duration cap can be as big, so we had to work on the duration side, address the risks, invest, for example, also in 100-year government bonds to get that done. And then on the other hand, we needed obviously also to have some return engines on the asset side. And that's when we started to build up our alternative assets program. And they are also a very important role, private equity. So our size of the book is around 20 billion euros, plus 3 billion on the unit-linked side. But today we focus more on those 20 billion on our classical life and annuity business. So when we started, we only had like real estate, which was the only, let's say, alternative asset. From that base, obviously, we then increased the real estate allocation in the portfolio, but also the real estate debt side, so commercial real estate loans. So we increased that up to 1 billion euro, which is quite significant for our size. And we made very good experience with commercial real estate loans. And then we added private equity, for example. And for private equity, we started 6 years ago, and we had a good build-up of the portfolio. So right now we have around 600 million euro invested, which is around 3% of our portfolio. And we also plan to increase that because we see a couple of advantages in private markets, also compared to the listed markets. So as Patricia said, when you look at the risk-return relationship, it's quite convincing, but also the volatility, and then additionally the volatility you have in your accounts. So for us, we have HGB, that's the German local GAAP, but we need to have our balance sheet. And there, when you have listed equity, there's a need to hedge that. Because if you're out of luck, it's 31st of December and you have some downturn in the equity markets, you might run into trouble with Solvency II numbers, for example. It makes it hard to manage your solvency. That's why usually, if you have a significant equity exposure in the listed markets, you have to hedge it. You don't have that need in that degree when you are in private markets, in private equity, for example. That's why we also have the plan to increase the private equity allocation and decrease the listed equity. So listed, we are around 4% for the moment. And overall, I think we have a quite big focus on alternative assets. So the allocation is around 30% of the balance sheet. You can't go much higher as a life insurance company because you still need to manage your duration, convexity position, the risk, Solvency II, the reinvestment risk. So you have to have around 2/3 of the balance sheet in traditional fixed income, also long duration paper. But where the real return, and so to say, the fund in the portfolio comes from, that's really from the alternative assets portfolio.
Thank you very much, Axel. Nicolas, could you please tell us about, your institution first and your alternatives program, please?
Sure, yes, and a very warm welcome to you all also from Munich. I must say it's a very excited Munich today with today's football match occurring at the Allianz Arena. But in terms of Munich Re, obviously a reinsurance company, but actually within the Munich Re group, we have two sources, if you like, of insurance, reinsurance, and also we have a primary insurance business, that's branded as ERGO, and is pretty much a European franchise, but also with businesses in India and China. So the result of that is that we have balance sheet assets of about 250 billion euros. Clearly, a lot of that is in fixed income, but a little bit like Axel's story as well. When you look back historically, we also had alternative assets, which were really very concentrated in real estate for obvious reasons. Within that, actually, a lot of Munich and German real estate, as you can imagine. So one of the principles that I think we've always had, and we'll talk about this a lot, I'm sure, today, is diversification. So one of the steps that we took within the alternatives bucket was to allocate to private equity. And we started that journey in 2006. So it's a trend or a journey that we've been going for 15, 16 years now. And when I think of the size of our commitments to private equity, that's about 6 billion. Remember, that's commitment, so the market value is a little bit less than that as things get paid back and capital gets called. So the market value is maybe half of that or so. We can talk more later about it, but that for us has been successful actually as a journey. It's if I think of those aims, Patricia talked about this, of diversification, it's very much helped with that. It's also clearly helped in terms of helping us to enhance our return profile.
Thank you very much, Nicholas. Let me continue with you then. What were the main challenges you faced when you started your program? Were those, I don't know, just to regulatory, from an accounting point of view, reporting, and how do you manage to solve them?
So I think that is for an insurance company, and again, Patricia talked about this, we're very heavily regulated, we've got to take account of Solvency II, so that's why our allocation at the moment is a couple of percent. I think in the future it's likely to increase. But in a sense, they're all challenges that you can overcome. Some would use the standard model, some would use internal models. Again, a lot of these things can be modeled. You can have a dialogue with regulators. You can educate your accountants on the practicalities of how these instruments work. So I think the sort of bigger challenge in a way is, I mean, how do you do it? I mean, how do you start allocating to this sector? Because what is private equity? It can be many, many different things. So the approach we took was to build a team. So we started small, but we've now a team of 4 whose sole job is to do, if you like, the fund selection. And if you think of private equity, if you like, at least the way we thought of it, the sort of flagship sector within private equity is buyout. I mean, you've got within that venture capital, you've got debt, you've got mezzanine funds, you've got many, many different sectors, infrastructure, debt, secondary funds, distressed, you name it. So we started with buyout, and then we've expanded, if you like, across the different sectors of private equity. So that's one way that we've got diversification. I think the other way that you get diversification with private equity is the idea of vintages. And again, with vintages, I think we often think wine. It's a little bit the same with private equity, isn't it? You know, some years are better than others. So you need to be allocating to different years. And I mean, then self-evidently that gives you a different starting point. So you've then got diversification, if you like, on another angle. You've got different sorts of funds, you've got different starting points, different payout profiles. And then the sort of final bit of it, the final challenge is, how do you select the precise fund? When we started, actually, it was very much fund of funds. You get diversification that way. And the way that I sort of think of the fund analysis is, think of it as not dating, think of it as marrying. And you've got to be in for the long term here. I mean, you've got to commit the capital for a period of time. So that's, let's say 8, it's 12 years. And you need to do the due diligence. And again, people approach marriage differently. what's fashionable in certain markets are those ideas of a prenuptial agreement. You sit down with your wife or husband-to-be, and you disclose your assets, and you say what will happen if something gets wrong. And some people draw up big contracts. That's the approach actually for private equity. Think of it as a marriage. It's a people business. You need to get to know your GP. They need to get to know you, and you're going to be with them for a long period of time. And so that's important. The final bit of diversification says, don't just have one fund, obviously. You need a number of different GPs or general partners. And then within that, you need a number of funds as well. So again, if you think of those lines of diversification, you end up actually with quite a diverse portfolio. And again, I think, as with anything, Patricia talked about it, that's one of the secret sources when it comes to investment, I think particularly with private equity.
Thank you, Nicholas. Axel, do you want to add something about the main difficulties you faced when you launched your program?
Yeah, sure. Maybe that's also an issue in some of the companies that are listening to us right now. If you start a new asset class, obviously there is some resistance internally. If you come with new proposals, then first of all, you get all the questions. Do we really need another asset class? What are the risks about the asset class? Do we really fully understand the risks? The high returns, they look promising, but if the returns are so high, isn't there triple the risk inside of it? So of course, yeah, we have to convince, first of all, internally. And what helped there was that, what I just didn't mention, that a couple of years before we started private equity, we started investing in infrastructure and renewables. So wind and solar were the first investments. And in a way, when you invest there, it's quite similar to private equity investing. So that helped us to convince internally that now we start with something new, but we also get some experience and knowledge because we always want to fully understand where we invest in. And if we don't at the very beginning, then we work together with managers. So our first then target was to pick a manager, and our idea was not to start with fund of fund, but to start with a managed account where we have like a deep involvement, where our team was able to really step by step climb up the learning and experience ladder and curve, so that we started with that managed account, and then we have in time more and more co-investments, pick our own funds, or also go on the private debt side, or also do some equity sponsored loans that come from the PE program. So I would say that was a good journey starting with a manager, but then the team got more and more experience. And if you ask today, there are no concerns. So all the supervisory committee, the management board, they are now happy that we started the journey because it was a quite good experience. And as Nicholas said, of course, there are different vintages. Sometimes you also have trouble, but then I always say, yeah, you don't only have complexity premium or an illiquidity premium in all those alternative assets. There's also something like a jitter or sleepless nights premium. Yes, sometimes you have that, but all the cases work out quite well. And even more, if you look at it from a portfolio level, so all the private equity or alternatives, it's really an excellent experience that we have so far.
Thank you. Actually, I will continue with you. I mean, you mentioned, and Nicholas mentioned something starting with fund of funds, with a managed account. It's important to have a diversified portfolio of GPs and funds, etc. I know, I mean, when we prepared this panel, you've done some direct investments as well. How do you decide? What do you? I mean, what do you do in-house versus selecting managers?
Yeah. So let's say more like the standard program where we have our strategy when it comes to like the styles, whether it's a venture or buyout, late stage, or the geographies that we discuss with the manager, and that's a part in our managed account. In parallel, luckily, we have now like get a lot of recommendations from asset managers or also brokers. And then we are quite open and look at many things. It doesn't mean that we invest in all of those proposals, but from time to time we have interesting things like investing into an operator of locomotives, so in the rail business, or we have a land-based salmon farming where we invested directly. We just recently invested in some gas turbines in Italy. So it might seem sometimes a little bit exotic, but at the end, we always do our homework with our team, and we look first at the risks. So we are not interested in the high return numbers. We want to understand what can go wrong before the yield we get is lower than like the return we would have on an equivalent corporate bond, for example. Because when you think about it as like a probability of regret, when you look back, the only regret that you would have is if your yield would be lower than the standard corporate bond you could have bought at that point in time. And if then we see that the case is so robust that also the scenarios, the probabilities, the tail value at risk, whatever is robust, then we want to understand how can you build up the return. And there, obviously, we are not super greedy. So we are more interested in the downside protection, not in like the very high double digits. So let's say if it's like 8%, but the chance to be below 4%, then we are happy to invest there.
Thank you. Back to Nicholas. Could you tell us also on how do you decide on doing things internally versus partnering with external managers? And maybe expand a bit on what do you look for managers you back?
Sure. Yeah. No. So I think again, the starting point in a very sort of similar fashion to Axel is the risk profile. So it could be an infrastructure debt investment or renewable project. We'd think of those, I think, as a little lower risk, actually, than some of our private equity holdings, and they're priced that way. And some of those assets are very, very suitable, clearly for the insurance assets. They tend to be long duration with very, very defined cash flows. And so a lot of those assets we would do directly, if you like. I think, though, it's there's almost here, though, a mutually inclusive circle, because, of course, one of the difficulties is in all these markets, what's termed origination. How do you get the ideas? How do you know the deal pipeline? And of course, one way you know the deal pipeline is if it's being really part of that ecosystem. And again, that comes very much from the relationship and can do with existing managers. So it may be that through those relationships, you're offered the potential for a co-investment in something. Or it may be an asset that somebody's financed the development stages for, and then they're looking for someone to finance the actual running of that asset. And again, the risk profile there could be very different. So so I think it depends on the risk profile. Certainly with things like venture capital, generally we're doing that very much through funds and experienced managers. And then some of the other PE sectors, it really does depend on the on the precise risk profile. In terms of what we're looking for in external managers, it's cliched to say, but it's what that USP is. What's the unique selling point? Where's the information advantage? Where are the relationships that manager has? So it's really looking at and trying to form a judgment on that. So when I look at the work that team of say 4 people are doing, it's comprehensive. So they'll be looking at the assets within historic funds run by those asset managers. They'll be looking at all sorts of metrics, invested capital calls, what the IRR was on those assets. They'll look at the distribution of returns. Did the manager buy 20 assets and the return came from 1, or did it come from a broader base of investments in companies? And so, and there's no good or bad there. There's no right or wrong, but it's really understanding what those managers do and how they've made their money. And I think with everything you're looking to see is what they do, was it luck? Did they just have luck when they invested, or have they got an information advantage, a process that genuinely is consistent and from that repeatable for the future?
Thank you. I go with a very straightforward question to you, Nicolas. We're trying to gather here some empirical evidence that private equity and alternatives work. What has been the performance of your program? Has it have you reached your objectives? How has it contributed to those objectives? Could you give some flavor about it, please?
Yeah, no, very much so. So I liked Patricia's presentation when she talked about the return numbers. Again, I wrote down she had a 10 to 15% IRR. I think it depended on the precise vintage, geography, all those things. But I think that's consistent. The allocation some of her investors had, 8 to 37%, were not there yet. But in terms of returns, to give a flavor actually of perhaps our worst return, the worst period from our experience was actually 2007. So again, remember, we start the program in 2006 with all these things you want a good start. We also invested in 2007, and most people will remember the environment then. Markets are frothy, it's at the top of markets, and we invested then. And the return on those investments, if you think of the IRR, the internal rate of return, it varied between 5 to 7%. Now that's plus 5 to 7. And so in truth, that's pretty good, I think. And again, goes back to this idea of investing across different vintages, diversifying the risk. But that was the worst point for us.
Very good. Axel, could you comment also on the on whether you met your objectives with your alternatives and private equity program?
Yeah, for sure. So we started later. We started in 2015, so 6 years ago. So we didn't have to go really through the very bad years. It was the build-up of the portfolio. We have invested assets in the private equity space now of around 600 million euro. We already had some first exits, but obviously it's still driven by valuations. But there it's in the low double-digit numbers. So we are a little bit cautious because yes, you only have the proof when you have a hard exit and then also your cash. But still, we are very confident that we reach our targets. And as I said before, we are not that greedy. So we didn't promise our supervisory board, for example, that it will be double-digit returns. If we earn net after all costs at the end, around 8%, we already would be quite happy because especially in the ramp up of the portfolio, our focus really is more on the conservative part of it. So it's very late stage buyout phase and also more weight on Europe in the program. So obviously now with more and more experience, we also add more early stage venture, other geographies like Asia. But given that we started with a conservative portfolio, we and also our boards would be happy with a more humble return at the end. But I personally, I think we will really end up with the double-digit returns.
Good. So, given these satisfactory results, Axel, how do you expect your program to evolve in going forward?
Yeah, it will grow. So as Nicholas just said, you all know there's a quite significant difference between your commitment and what you have invested. So we are around 600 million invested. And then it's also quite a challenge to always decide how much do you need to commit new to get like to not fall back in your exposure, because once you see the exits, it can be a quite bumpy road when you talk about invested assets. So that's what we are managing. But our plan really is to also get out a little bit of the listed market and add more to the private markets. So our target allocation is 5 to 6%, which means that also we quickly will go above 1 billion euro in absolute numbers, because we are still like a fast-growing company due to our business mix with a lot of annuity business. So that's why we will also reach like the 1 billion threshold, but that's not the end, because we want to have then 6% of our assets in the private markets.
Thank you. Nicholas, about you, your program is more mature. How do you expect it to evolve in the foreseeable future?
Yeah, no, I think as you look out over the next 5, 10 years, something like that, I mean, at the moment we've got between 1 and 2%. There's no reason that over that kind of time period, it could well double. So again, in percentage terms, small, but that's a meaningful cash increase there.
How do you view it in light of the current environment? I mean, is that changing your views at all? It's harder than ever to obtain returns. Valuations are high across asset classes. How that, do you share this vision, and does it influence your program in any way?
I think there'll be a lot of competition for the assets. So everyone will have their own view on interest rates, but I think in a world awash with debt, its interest rates stay lower as opposed to higher. It suits governments, it suits corporates, it suits individuals. So then I think that forces people to do other things with assets. And again, it was mentioned earlier, at one time you got 7% on a Spanish government bond. You're not getting that ever again, in my view. You'll be lucky to get 0. You'll get your money back, but I mean, Spain's a strong credit. It can issue at really low rates and will. So then you're forced to do, if you like, other things. And then it's a question of what, isn't it? So already, if you like, that becomes a world that's slightly alarming, because you've got lots of capital and it may be chasing things. So you're back, I think, to the idea of due diligence, to research, to thinking of the risks. But I think when you've done that, private equity is one of those assets that I think is a natural home. And again, I think the interesting thing I've always found is a lot of the businesses that you end up investing in, you can understand. Depending on the sectors that they're investing in, at times they can be very cash generative businesses. Not all, but some of them are very real economy businesses as well. So again, I think with the right due diligence, the right approach, yeah, accidents will happen in the sector, but if you do your homework, I don't see why money doesn't continue to go into that sector.
Thank you. Axel, could you, I mean, you're planning to grow your program, as you said. What are your main challenges or your main concerns in further growing your program?
Yeah, I would say also similar to Nicholas from like the market side, and that's why in a way also it's a little bit two-sided sword that we spread the mouth here today about the benefits of private equity, because there is already a lot of demand and maybe the audience gets some appetite afterwards. But okay. That's still welcome, but at the end, yes, you really gotta be careful. It's like it's not only a trend; it's more like a boom. So you gotta be careful about the specs, for example. So we wouldn't like blindly give too much money into specs, and also on the classic private equity side. I think you got to be careful, do your homework, don't get under pressure, take your time for the due diligence, because as we had it with fixed income, when you said it's covenant light in a way, it's a trend also in the market that you don't have a lot of time. Sometimes you want to have the transaction, but we want to keep the discipline, and luckily, we're on the same page with our asset manager. So we better say goodbye to a transaction than we are sorry a couple of years afterwards that we jumped too quickly, didn't do the homework and the due diligence. So I would say that's really a challenge from the market side. But on the other hand, I think there are still a lot of opportunities, and we see that. Especially when you have a reputation in the market that also you can do transactions. So sometimes it might be the special transactions, but there, let's say, our old-fashioned name sometimes also helps, because we are not like a hedge fund. So the people kind of trust us as an investor, because we really want also the long-term relationship. And that's why we are still confident that we will find also enough opportunities to grow our program, even though there is a lot of appetite from more and more investors.
Thank you. This is a pretty good recommendation from your experience. I don't know if, I mean, we're running out of time, but I've been told we can take an extra few minutes. I don't know if Nicolas or Axel, you want to add something, or you want us to go into the questions from the audience. Angela, if you want, I did receive them, so if you want, I can go over them. But is there something, Nicolas or Axel, you want to add, or should we go into the questions? Are you okay? Questions then?
Very happy to go to questions.
Yeah. Nicolas, since I have you big in my screen right now, there's a question about, a question about impact. I want to make you a wider question about ESG in general. How is ESG impacting the shape of your program? And do you see impact investing, which is a little bit like the extreme of ESG, becoming a part of it?
So certainly, I think ESG as a trend, maybe this is a statement of the obvious, is massive. And I think it's enduring. From the Munich Re perspective, it's very central to the investment philosophy. So we joined the UN Net Zero Asset Owner Alliance, AOA. So what practically that means is that by 2050, our entire investment portfolio will have greenhouse gas emissions in line with the Paris Accord, no more than 1.5 to 2% global warming. So I think sort of practically there's two levers in a sense. One is we can reduce, if you like, publicly listed equities or bonds from companies that are big polluters. And we can either sell those or we can engage with those companies. Very much the preference is engagement. We do that. But then really for the private market side, I think there you have very big levers actually. And so in practical terms, what we announced at our Investor Day in December is that we would double our allocation to renewables by 2025. So that's from 1.5 to 3 billion. De facto, a lot of those assets are private markets. And again, a lot of those you consider under the umbrella, the broad umbrella of private equity. Some assets there have a very obvious link as well, I think, to ESG, whether it's sort of forestry and things like that. And again, we'd put that in that sort of big bucket. But I think ESG will become an enduring theme. I think private markets, private equity is an interesting way to play that theme, and it does have a real world impact. And again, you can see it. I mean, Munich Re issued a green bond a year ago. As part of that, every year we do a green bond report. You can see the assets we've bought, and you can see the impact it's had on CO2 reductions. So that's sort of what I like about ESG. We're doing the right thing, but also the impact we're having in many cases is measurable, and I think that's very powerful as a combination.
Would you even consider impact funds, and would you be willing to maybe sacrifice part of the return for social impact?
Yeah, we certainly. We'd certainly absolutely consider those funds. I think that's one of the beauties, isn't it, of financial markets? They're innovative and new ideas come, and it may well be funds like that have a place in our portfolio in the future. Because again, I think there's one side to it, the return, the other is the risk, and then the combination of that, potentially you build better portfolios through more diversification.
Thank you. I will address this question to Axel. There's since you, I know you work a lot on this, is the impact of Solvency II. I mean, there's a question on the audience of, do you expect that? I'm gonna put together a few questions we got around that. One is that really constraining your ability to invest in private equity? Do you expect that Solvency II will influence if you invest more or less? And also, I think given what we heard from the BCG report, do you think regulators will listen and will eventually modify those capital consumption ratios?
Yeah. So first glance, it could be an obstacle because yes, as we also have seen in the presentation from Patricia, the Solvency II requirements are rather high. So you're talking about the high 40 percentage points that you need. So when you then look at the return on your risk capital, it's still more than okay, because let's say if you look at a fixed income instrument and you have a Solvency II requirement around 15%, but you are happy to make a return of like 1.5%, the quick math that still the ratio is better in private equity. But if you are like restricted in risk capital and it's a scarce resource in your company, then it might be a problem. Therefore, my recommendation is do the homework on the risk profile overall. So do your liability-driven investment ALM analysis, and then try to reduce the risks, for example, on the unrewarded side when it comes to duration and convexity gaps. And then the room you get, you can really invest in what's called then a performance-seeking portfolio, which then could be private equity. And then you don't have a lot of headaches about how high the capital requirement is. But also I'm quite optimistic that the numbers will come down, because we just heard that ESG plays more and more role, the transformation of the economy, new business models, the tech models. For all that, we have a responsibility as asset owners. And I have the feeling that politicians and regulators more and more understand that it might be even easier to have us as asset owners to really make a difference in transforming the society and business might be easier than with all the regulations and from the political side. And that's why I really think, as we have seen it also with infrastructure, where you have a capital release, if it's qualified infrastructure, that you also get a capital release. The idea is already out there. It's called long-term equity. There you only have 22%, so less than half. But theoretically, you could put private equity in there. Practically, we tried. It's quite difficult to achieve that because you need to have a liability pool that is directly linked to those assets. But if you relax that a little bit, as we observed it in the infrastructure space, I'm really confident that also the capital requirement will go down. Maybe if you have some positive side effects that you say, okay, it's gotta have some ESG or positive impact, or at least not harm the economy, that you have some exclusion lists. So to cut it short, yes, I think if you do it the right way, so of course, not like hiding what you can't invest anymore, which is like dirty from an ESG point of view in your private equity portfolio. I guess that won't work, but if you do it in a good way, I really think there are chances that you also get some capital relief on the private equity side.
Thank you. There are some other questions, but I'm going to just launch the last one for you, Nicolas. And this is a question on how much do you allocate to managers within your own country versus in other jurisdictions?
We're totally global. So totally global mindset. What we want is the best managers. We're not, we don't worry. They don't have to be from Germany. They don't have to be from Britain. We just want the best managers. And I think with that global approach, I mean, that's one of the other keys to investment, isn't it? We operate in a global framework. And I think there's good managers in every country.
Thank you very much. I'm sorry, we would spend a lot more time with Nicolas and Axel. Thank you very much for sharing your experience and complementing the results of the BCG report with your own experience, with your own facts. I would highlight 4 things, basically, or 5 things from what you said today, which I think very much fulfill the purpose of today's webinar. I mean, private equity and venture capital has effectively helped you enhance your returns and achieve returns in the range of 10 to 15. Diversification is on one side a benefit, on the other a requirement. And even within your private equity and venture capital portfolios, you are getting less volatility than you're getting from public markets, sorry. And I like the word you mentioned 2 words. This is a journey and this is a marriage. It's definitely long term, and we should all think long term about our alternatives and private equity and venture. And finally, another message of optimism. You're all looking to increase your programs, so hopefully investors in Spain will follow, or in other parts, we have people from Latin America as well joining today, will follow this path that has worked so well for you. So thank you very much. A huge thank you from everyone. I think this has been great and definitely more than what we expected. So thank you very much for sharing your time and your experiences.
You're welcome.
Thank you.
Goodbye then to everyone. Thank you for joining.
Goodbye. Take care.